This tutorial covers credit and financial analysis with a focus on how to read and interpret a balance sheet. There are three primary learning objectives for this tutorial. First, we're going to have a brief review of the components of a financial statement and certain things that you should be looking for when you're doing an analysis. So first, for a brief review, there are critical components of a financial statement and things that you should be looking for. First, there's the balance sheet. Then there's a profit and loss statement, cash flow statement. There are certain key ratios that are very important when you're doing an analysis. And then you should look at performance over periods of time and look at trends. Is a company improving, they're remaining flat, or are there things that you should be concerned about in their performance? You put all this in a context by benchmarking with similar companies. So this tutorial focuses on number one, the balance sheet. So here's a sample of a balance sheet, and you can see it has a lot of detail on here. It's very valuable detail. First of all, I like this particular version because it has references to notes. Notes are very important in a financial statement because it'll tell you a lot that you need to know to really understand these numbers and find areas that you might be concerned about. So why is a balance sheet important in the first place? Well, it details the company's assets for a starter. This provides you a window into the company's liquidity and their ability to generate cash from the assets that are on the balance sheet. It also shows you the assets that are available for sale at a later date and what the assets that they have available to support the company's basic operation, equipment, etc. It details the company's obligations. What do they owe creditors, banks, trade creditors, etc. It's important to understand both what's on this balance sheet and off-balance sheet obligations, which we'll be talking about. Lastly, it details the company's equity. Who owns the company? How is that structured? Looking at it over time, how is the equity performing? Is it getting greater? Is it getting less? Are there sudden changes in equity that you should be concerned about? It's a window into who owns the company and how.